G'day guys, how's it going? Haven't made a video for quite a while. So today I'll get the camera out and make a new video, and we'll talk about current economy and in particular the 10-year bond yield. For Australia, just go over 5% yesterday. So yeah, that's something I want to bring up, being over 5% as a 10-year bond yield, and that's pretty high for any major economy at the moment. And we've had 5% of a bond yield for 10-year in Australia in May and June. March. I had it in March and May, sorry. And then we now July we have like 5% of a bond yield again. So something alarming is because we have this anything over 5%. It's going to be some kind of inflation coming up, or a potential rate hike or sort of thing. So definitely as inflation gonna pick up again, and because of the second round of US-Iran war. So yeah, the peace deal was torn, and now we have like missile exchange of missiles now in US-Iran war. So yeah, it's not very optimistic for the current Middle East situation. So yeah, it's definitely gonna affect us in many ways, and particularly the inflation. The inflation gonna stick around for August and potentially September. So being over 5% of a 10-year bond, and that is a result of a market. A market buying and selling, so they create this kind of 5%. It's not like a regulation by a central bank or a treasury or anything. So that's real money put in together, and we trade it as 5%. So yeah, that's expectation of the big money, and the inflation will be sticking around. All right, and it could potentially go even higher. We've seen the oil price going from 70s now to upwards of 95, and potentially gonna break 100 again. All right, so that's something pretty alarming for August. So the August is going to be a bit of problematic, in terms of the interest rate, the borrowing cost, and the unemployment and general economy, that sort of carry on. So I would forecast. I have a Chinese channel. I kind of like did it quite a while, a couple of hours ago, and I forecast in August we're gonna have a correction in a property market, simply because we have quite high of a 5% of a bond yield for the 10-year, and that means the big money is pulling away, and yeah, we have very strong bond yield, and so that's very attractive for the bond investors. So the money, the interest rate is simply too high. They're gonna pass it on to the borrowing cost of real estate. Buy a house. You're gonna borrow money. It's gonna be way over 5% of interest rate, and with current house price, and compared to your income, so it's relatively high. And with the investment money pulling away, as you can see from the bond market, yeah, the bond got sold out. The bond gets sold. So you know, they have a very strong expectation of the inflation, right? And so it could potentially affect, not potentially, surely gonna affect the housing market in the eastern coast, as eastern coast has a very strong investment, background. The investment from the big banks, big institutions, right, from the U.S. and Japan. So yeah, for Perth, it's will be generally better than Eastern Coast because we have a lot of actual, demand for the living, right, for people who actually move here and living here, while the Eastern Coast have a lot of investment, right, a lot of hot money going on in the Eastern Coast, which is very sensitive to the interest rate, to the bond yield, right. Once the bond yield goes up to a point, and it's going to be very dangerous for the investors, in terms of the money, borrowing money, the cost of borrowing money, right? So that means if the inflation keeps sticking around, and that potentially could cause, the Reserve Bank gonna shrink the balance sheet, or they increase the interest rate. So two ways of doing things, right? There's not only just interest rate. They have balance sheet. It's a most people don't understand or don't care about the balance sheet, but it's a balance sheet, something they play with it. Japan like it. The Japanese are they're gonna play the game rather than they increase the interest rate, right? The central bank interest rate, something they don't want to do. What they're gonna do, they're gonna shrink the balance sheet, and therefore they could potentially increase their bond yield. Japan bond yield, 10-year bond yield is very, very high, 2.7, something like that, and they want to even higher. Look at the yen, in the forex market, it's definitely got sold out. It's like 163 at the moment compared to the US dollar. That's historically low. So yeah, Japan, the Central Bank of Japan, they want to increase their 10-year bond yield to defend yen, right? So what they're gonna do, they're gonna shrink the balance sheet, So that's what they said by the central bankers, I can't remember the Japanese name, but yeah, the director, of the Japanese central bank, said, yeah, they're gonna shrink the balance sheet. So for Australia, we have 5% of this interest rate. Is very, very high, and gonna shift the investment, the big money, what they're gonna do in terms of the stock and the real estate investment, So I would forecast August and September, we're gonna have a price correction, in Eastern Coast, yeah, and Perth will be following, but would be a better situation, yeah, because as I said, Perth have a lot of people actually need a house to live in, right? And not that much of $1 billion hot money going around from one institution in Perth, Most of them, they're concentrated, in Eastern Coast. There's money from BlackRock, Blackstone, from Japanese big money. There's a lot of Japanese carry trade going around in Australia, in the US, two of their favorite places to play Japanese yen carry trade. So yeah, as that has been going around for the last decades. We have historically low Japanese interest rate. The yen interest rate has been zero for decades, right? And basically the borrowing cost in Japan is very, very low, and as I said, it's zero, right? There's no borrowing cost whatsoever. So yeah, they can borrow the money, buying a real estate, or buying Australian stock, Australian bond. You get, as I said, you have 5% here investment return, while in Japan now they have 2.7% return, right? So they have very high of interest rate as well. Not interest rate, the bond yield as well, simply because the yen has been collapsing, right? So Central Bank of Japan, they had to increase the bond yield of a 10-year bond to defend the Japanese yen. This is what they call it as YCC. So yeah, the Japanese has been playing this game for a long time, for decades. We use YCC, yield control curve, to raise their 10-year bond yield and to defend their currency. China does the same. We use YCC to raise a 10-year bond yield to defend the CNH, which is offshore Chinese yuan. So yeah, both countries are doing YCC to defend their currency, while Australia and US, we don't normally worry about our currency. Forex market, is a free trading market, in the Forex for our currencies. So yeah, there's no motive behind for the Central Bank of Australia to defend the currency or whatsoever. So that's all good for them. The only thing they worry about is the economy, unemployment, and inflation. Yeah, big one. Yeah, for Japan, they also worry about inflation. If your currency is way too low, and then when you import, you gotta deal with very high inflation, because Japan will rely heavily on their import, right? It's pretty much everything importing, particularly those oil, right? Everything. They don't produce any oil, so all the oil is imported, and then they make into all those products. So if their currency is way too low, and then they're going to affect their import price, and they're going to have a follow-on effect to their economy, which means high inflation. With that said, the interest rate being that high, that won't be forever. That depends on what will be going on in Middle East, and see will the war gonna calm down. So something we will look at. If the war accelerate, and the forecast of the inflation will be higher. And the real inflation will be higher too. They're going to be reflected by the oil price. If the war calm down, and then the oil price will be lower, and the expectation of inflation will be lower, and then that'll be good for the economy, and and the interest rate could fall. But right now, I don't see anything get better soon. In the Middle East, we see the Iran and the US exchange missiles, and just picking up. So that's a pretty bad situation going on there, and then that's reflected in the 10-year bond yield and oil price and everything. So August, as I say, there's nothing optimistic in August. So there will be a price correction in the eastern coast, and a smaller correction in WA, Western Australia. And that's my personal opinion. I hope September will be picking up better, and the situation in Middle East will gradually become better. So we all have a better life. Don't want war. Definitely affect us in a negative way. Go out travel. Invest. It's just your asset price falling. So it's nothing good. Yeah, nobody like war. Hurt people in many ways. So in Australia, we have a very sensitive, pricing. If something goes up, inflation goes up, right, and we will have higher wages. The government will increase the minimum wage, and then everything will be more expensive. We have minimum wage of $25, right? Just very, very basic. Any basic job, that's a starting point for any employment. So, yeah, if the minimum wage gets increased, and everyone going to be more expensive, we're gonna pay for everything more expensive. It's not like some of the countries, right? When they have inflation, they just let it run and until and they will have like unemployment. Just let the unemployment happen, and then let the price fall down. By nature, because once people lose their job, and then there's no demand, no people buying, and then automatically the price will fall. So that's what had happened in China the last few years. They have shrinkflation, not shrinkflation. They have deflation. Yeah, so that's pretty cool. See the price actually fall. So your money worth more simply because people have decreased salary, or some people lose their jobs, and rather than the government print more money and handing out more to those unemployed. So yeah, the policy we have, in Australia and New Zealand, they're gonna just print more money and get people have higher minimum wages. So people who are skilled, that will be on a skilled job, they just have to pay more for everyday services and products, right? And your purchasing power will be lower. So that's a bit of unfortunate. In terms of the asset price, with this high inflation rate and high interest rate, definitely not good news for the asset price either. So yeah. Yes, it's great to catch up again with you all, and hopefully I will catch up again with you next time fairly soon, hopefully the weekend. And everyone have a great day. Right, see you guys later. Bye.